So there are decades when nothing happens and weeks where decades happen. And the latest blow to the United States actually comes from Saudi Arabia. No, they aren't pricing oil in the Chinese yuan or the rial yet, but they are dumping a ton of their US Treasury holdings. And this is a big deal because we have been hearing news of America's push for a peace deal between Israel and Saudi Arabia, and that was supposed to include a pact to keep using dollars for oil trade. But that is apparently starting to break down, with the United States themselves downplaying the odds of success. America is starting to lose control of the petrodollar, and this is confirmed with Saudi Arabia's move away from US Treasury bonds. In a big update, Saudi power of US Treasuries at 6-year low in shift to risk. The kingdom sold $3 billion of US debt in June as they move towards riskier assets. And here's the crazy thing, this has been happening for years right under our noses. The kingdom has been deleveraging their bond holdings for quite some time now. From 2016 to 2020, the Saudis were piling on US debt. They were taking their oil revenues and buying treasury bonds until it peaked out at $184 billion. But now they have reversed direction. They have sold 76 billion or 41% of their entire holdings over the last 3 years. That's even more aggressive than China. And it's all about the timing. This comes on the heels of a massive de-dollarization wave across the global south. China is selling, India just bought oil in rupees, and now Saudi Arabia is losing faith in US debt. And this is bad for the United States, both in the short term and the long term. America is already borrowing a ton of money today, racking up an incredible amount of debt. In Q3 alone, America borrowed $1 trillion and is facing a fiscal crisis where they have no choice but to keep issuing bonds. Demand is going down, but the supply is going up. So if China isn't buying and Saudi Arabia is dumping their debt, investors will demand a higher yield to buy the bonds, right? This piles more pressure on the United States. The national credit card interest bill will balloon out of control if this keeps continuing. Now let's understand the significance of this move, because actually more significant than China dumping their US treasuries. Now Saudi Arabia is actually unraveling the historic petrodollar agreement, at least one part of it. And let's quickly recap. Now the whole point of the deal in the 1970s was for Saudi Arabia to sell their oil in US dollars, but that's just one half of it. The second part is just as important. The Saudis were then required to take these proceeds, the dollar revenues, and recycle them back into US treasuries. And that is what the Saudis are breaking apart by selling their bond holdings. Now, the whole point of this recycling was to ensure a constant demand for US treasuries. If Saudi Arabia keeps funneling their dollars into treasury bonds, they keep the cost of borrowing low for the United States, right? In exchange, the Saudis will get a risk-free investment while enjoying some yield. Now, just to clarify, I call it risk-free because treasury bonds are essentially guaranteed by the Federal Reserve. If anything goes wrong, they will likely just step in and print money, and you'll definitely get back your nominal amount. But purchasing power is an entirely different issue. But the fact remains that Saudi Arabia is no longer playing the game. They aren't recycling their dollar revenues back into US debt, and this changes everything. It's just a matter of time before they break the first part of the deal, which is pricing oil in dollars. And once that happens, there's even less incentive for MBS to buy treasury bonds. They will channel their investments elsewhere. And let's take the UAE as an example. It wasn't just the Saudis that sold off US debt. The Emirates also sold nearly $4 billion worth as well. And why did they do it? Well, maybe it's because they are now selling their oil outside the reserve currency. And this is quite surprising because we always thought the Saudis would be the first movers here. India just bought 1 million barrels of oil from the UAE using Indian rupees instead of the US dollar. And this is unprecedented and unlocks a brave new world for the Middle East and OPEC. The dollar backlash is just beginning, and guess what, guys? The BRICS summit is happening in just a few days. All these events aren't a coincidence. We are seeing a systemic shift away from the dollar system. But let's analyze why the Saudis are breaking away from US treasuries. And this is quite surprising because it goes against the common narrative that US bonds are safe haven assets. And unless you're living under a rock, you probably know the world is slipping into recession. The signs are all screaming that a global slowdown is coming, right? We have the Eurozone in an official recession. China's consumption is slowing down, and they have a big real estate problem to solve. Plus, the world's biggest consumer, the United States, is now consuming less. We can see since 2022, the US has been importing less. Imports have dropped by at least $30 billion. And this is a clear sign that demand is falling across the board and a global recession could be coming very soon. A ton of economists are predicting doom and gloom for the economy. Weakening consumer demand for goods has softened imports this year, while exports continue to trend downwards as the global economic backdrop softens. Under such an environment, the Saudis should be buying US treasuries hand over fist. They should be piling on a ton of US bonds because there is an implicit Fed guarantee tied to it. Plus, if you look at bond yields, it is looking real attractive across the board. The 3-month is yielding 5.4%, while the 10-year is above 4.2%. The yields are higher than inflation, which means you're actually getting a real return. But the fact that Saudi Arabia is selling off bonds tells us that there are actually real risks involved in holding US debt, and the most obvious is the threat of US sanctions and weaponizing the dollar. They have seen the freezing of Russian assets, the trade war with China, and the G7 price caps on Russian oil. But there's also a big default risk looming when it comes to US debt. Treasury yields are now reaching a 16-year high, which is extremely bad for America's national debt. And here's the situation. The US economy is being propped up by a ton of deficit spending, and that is preventing a recession from happening. And that's why the rest of the world is collapsing except for the US. But because the Treasury keeps borrowing money for Congress to spend, this puts upwards pressure on bond yields. We can see the 10-year yield is now at 2008 levels just before the great financial crisis. So America is now caught between the devil and the deep blue sea. If they stop borrowing, a US recession is all but guaranteed. And if they keep borrowing, the debt will become unthinkable. Remember that servicing the annual interest is reaching $1 trillion, and this situation just compounds on itself the more America borrows money. And that's why the Saudis are looking to diversify away from US debt, because either outcome is crazy. Either the US eventually defaults through non-payment, or they inflate the debt away with money printing through the Federal Reserve. It's either a classical default or currency devaluation. Both are unthinkable. So what is Saudi Arabia doing with their money? How are they exactly investing? Well, they are buying everything from US stocks like Uber all the way to football clubs like Newcastle United. I mean, if you have to buy Newcastle versus Treasury bonds during a global slowdown, it kind of tells you the headspace the Saudis are in. If we track Saudi Arabia's PIF, which is their sovereign wealth fund, they are buying a ton of American stocks. This includes Lucid Motors, Activision, Meta, and Starbucks. Remember that these stocks are at high valuations, which tells us that the Saudis are actually willing to take a big drop in price if a recession hits. They rather buy risky assets and take the hit than hoard treasuries. And as the West calls for China's collapse, Saudi Arabia is actually piling more money into Chinese stocks as well, like Alibaba and JD.com. In just Alibaba alone, they have increased their stake by 41%. So you can literally see where the money is flowing to. The Saudis are buying up stocks around the world, including the United States and China. They trust private companies more than the US government bonds. And just imagine if this move away from treasuries spreads across the rest of the Middle East, right? What if OPEC nations start moving away from the safe haven asset into other investments? And according to the IMF, they predict the Middle East will enjoy over $1 trillion in extra oil revenues in the next 3 to 4 years. But because oil prices could start to come down due to the global slowdown, the Gulf states will be aggressively saving their surplus. And the big question is, where will they invest their money? It could be shifting towards renewables, they could be buying more stocks, they might even be stacking more gold. But if OPEC nations diversify away from treasuries, this is a big problem. It's a nightmare, especially when Janet Yellen is selling bonds like no tomorrow. What's happening is a chain of events, guys, that is gradually getting from bad to worse. Remember what happened over the past few weeks? Yellen made an announcement that the Treasury would be selling another 100 billion in long-term bonds. That triggered a sell-off in treasuries that led to yields spiking up. And what did that do? It spooked the rating agency Fitch enough to downgrade America's credit rating down to AA+. Now, if the Saudis are buying football clubs, you know that they are really diversifying away. And this is the problem when borrowing goes out of control. If you're America, you have a hard choice to make, right? Do you stop deficit spending and face a recession? Or do you double down and keep borrowing to kick the can down the road? Because eventually the music will stop. If you go through door A and you stop borrowing, the economy could very well implode, consumer spending would dry up, and asset prices could collapse. But at the very least, you kind of restore some confidence in the dollar and the treasury market. But if you choose second option, door number two, and you keep doubling down on debt, you'll eventually face a fiscal cliff where you can't borrow anymore. And let's put up two simple charts and you quickly see why this is a big problem. The first is the US debt service cost. Right now, we are in an environment of higher interest rates and the debt servicing cost is reflecting that. America's overall debt used to be below 2% interest rates, but we are rising towards 3% in a very short time. So if Yellen keeps borrowing and the global south keeps dumping bonds, we could see this rise towards 4% or more. And that drive the bond payments to the moon, especially when all the old debt matures and has to get rolled over to higher interest rates. Now the next chart is the interest payments on the national debt. It is about to hit $1 trillion, which is an emergency. That's almost 4% of US GDP in 2022. And as this number snowballs, it traps America in a deadly borrowing spiral. The higher this goes, the more likely the chance of a real default. Now, I think there's still time to salvage the situation, but that involves borrowing less now and confronting a recession. You either face a crisis today or absolute monster down the road. So what does this mean for you and me? Now, if this treasury dump continues, we'll see bond yields continue to stay high, and this means money market funds will become even more attractive. But on the flip side, higher interest rates means more pressure on the overall global economy. Spending is going to dry up, and companies just can't grow as fast. So there's this duality we need to understand. Remember the tailwinds coming for the US economy. The Federal Reserve could very well hike interest rates again in September or November. Now, this hiking cycle probably isn't over yet. The Fed has come out saying inflation is still a big problem and rates could go even higher. And we have to prepare for a world of elevated interest rates because the whole world is tightening. Saudi Arabia and China selling their treasury bonds is also a type of tightening we can't ignore. And we don't know if the banks can survive higher interest rates or if the US government will keep borrowing to kick the can down the road. But things are getting really interesting as we move towards the BRICS summit. And check this out, India and China are now looking to have bilateral talks with each other to smooth out any tensions. And if they come to some sort of agreement or understanding, this will just open the gates for more BRICS membership. We could very well see Saudi Arabia, the UAE, and other countries join the bloc very soon. And if that happens, the dollarization will continue and accelerate. The sell-off isn't going to stop. But let me know what you think in the comments below. Will Saudi Arabia keep dumping US treasuries? And more importantly, will they be joining the BRICS very soon? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.